on this leg of Lunch Money, let's also put the spotlight on the global cues. In fact, the Fed decision and what it means for the markets. Naeem Aslam, Global Head of Analysis at Ava Trade, joins me on the show from London. Thanks so much for joining us today, Naeem. A lot of speculation has been going around about what the Fed is saying and what it is doing, and finally we've got a pretty clear indication from what we understand that there could be a hike in December. What is the sense that you get, and what does it mean for global liquidity flows?
Thanks very much for having me. Yes, I think the Fed have been extremely poor in communication. The entire communication process has just been very appalling, if just not rotten. Because if you just cast in mind what really they said back in September, they were very dovish, even though when the data was very hawkish. Now we have the complete opposite in terms of the data and what we have received in a statement. Market wasn't expecting that much of a hawkish statement given what the economic data has been printing since September. We had a very much bad reading. Nonetheless, yes, now finally they are saying that they are ready to raise interest rates, and they have certainly pinpointed a particular month under certain aspects of it, and that could be in December. So yesterday, the move in the market was pretty much okay. That the Fed are not that much concerned about the volatility around the world, especially when we are talking about People's Bank of China and over in Europe. So perhaps they are feeling a bit more relaxed about the volatility in these markets, and that they are more concerned about the domestic market now. But remember, this coming Friday, we're going to get the GDP rate data, which is not going to be that great.
Right. I'm going to ask you about what this means for the markets. You know, there was a view that the rate cuts, especially after what we've seen from the ECB or the commentary from there, what we've seen from China, the Bank of Japan's general tilt, that the rate hike would be pushed to the first quarter of next year. Now that doesn't seem to be happening. What does it mean for global markets, equities in particular?
I think in equities in particular, obviously that means that the cheap money is about to leave the town, and then that party will be over. So if the Fed, number one is that how much, the question is that how much the Fed is going to raise. Obviously, most of the analysts and then the market participants are expecting the rate could be going up by 25 basis points. But the thing which really annoys me that why are we just only thinking about 25 basis points? Yes, we do know that the Fed is really itching to raise interest rates, and then perhaps their statement last night was pretty much targeting that aspect. But it doesn't say in any particular book, or at least I haven't read one, where it says that the Fed can only raise rates by 25 basis points. It could anywhere between 0 to 25. So I think how the equity market or the markets around the world, especially emerging markets in India and in Brazil or in or in China, how these will react would be how much and then how fast the Fed is going to increase the rates. Because GDP data, as I said, this coming Friday is going to give us a very distorted reading. We have a trade balance, which was again distorted, and then
I'm not sure what you said.
Industrial inventory data, not really that great at all.
Right, Naeem, the general sense seems to be that once the Fed starts increasing rates, there could be a pretty rapid increase in rates going forward. Yesterday, we had Robert Parker from Credit Suisse who said that by next year, this time, we could look at a Fed rate hike of anywhere between 1 to 1.25%. Do you hold that view as well? Is that the trajectory that you're looking at?
I think that the Fed would very much be, again, data dependent. And then the two things which will be quite important for them would be the data for the November and for December for the U.S. non-farm payroll. Now, how we are predicting how much that they're going to raise, or if they're not going to go back and then just, rather than increasing the rates, they will say, okay, that we're going to just keep the rates as it is, or perhaps will go down. Because if you look at the Phillips curve, which the Fed does use for the inflation, 3.5 trillion, not million, money has been printed since the financial crisis, and the inflation hasn't moved. One of the mandates for them is to improve inflation, the price stability, and unemployment. Unemployment is becoming soft. In December, what is really important to focus, we have two banks. We have the ECB who were ready to add more stimulus on the 3rd of December, or that's what Draghi at least said. And then if the US and the Federal Reserve, they also raises the interest rate in December, we are talking about enormous amount of volatility in the market. I don't think that the two banks will trigger at the same time. I think in December, if they do, there's a lot of volatility.
Okay. What does it mean for emerging markets like India? How are you seeing the flows coming in over here, Naeem? Because this is also the end of the year when we start to see a lot of the allocations, especially for emerging markets and India as a result. There has been a change in the MSCI index, or the way it is looking at and including Chinese ADRs, for instance. What does it mean for inflows, and what's your call on the Indian markets?
I think Indian market is still very robust regardless, because just in terms of a trade balance, it's just not that much dependent on the dollar denomination. But let's just look at it from the emerging point of view. If they are saying that, okay, they are comfortable with the steps that People Bank of China are taking in terms of a stimulus, they have cut the reserve ratio, and then they are also cutting the interest rate. And we are expecting a lot more in the next year as well. So if the Fed feeling comfortable what they are doing, obviously it wouldn't have that much of an impact. If you look at the fund flow from perspective, since September, we have seen a little surge of the money going back into the emerging market, into the MSCI index. And that was just on the back of the expectations that, okay, that the Fed perhaps are not going to raise the interest rates that soon. But now, yesterday's statement has completely changed that story altogether. Now we are looking at, okay, that the Fed could be increasing the rates perhaps in December. So, obviously, investors will look for a better return, and that better return is not going to be that much in emerging markets. Yes, the risk-to-reward ratio, I would love to take that risk-to-reward ratio when it comes to emerging market. But when you're looking at more stability, and then you're talking about less volatility, then it's not the emerging markets where you want it to be, then it's going to be the US and the developed market. So we do see that the money would be flowing back into the US, and then the funds that we have seen flowing into the emerging markets in the previous last few weeks, that would be again, the pace of that growth would again slow down.
Okay, Naeem, thanks so much for your insights. We leave it there. Thank you for joining us from London.